All right, let's jump straight into this explainer. Today, we're breaking down exactly how traders exploit these tiny micro inefficiencies in the global currency market to actually pull a profit. Now, think about this for a second. Instantly buying low and selling high across entirely different platforms before the price gap even has a chance to close. Honestly, it sounds a bit like a cheat code or, a glitch in the matrix. But in the insanely interconnected, high-speed world of global finance, these little glitches are happening all the time. So, here's our roadmap for today. We're going to cover exactly what forex arbitrage is, how you actually execute a trade, who the major players are, the absolute necessity of liquidity, and we'll wrap up with the top brokers to look out for in 2026.
All right, Section 1, Explaining Forex Arbitrage.
Okay, so unlike traditional trading, where you're poring over charts to predict long-term trends, arbitrage is all about the right now. Because of these microscopic delays in pricing updates, a major pair like the euro to US dollar might be just a fraction of a cent cheaper on one broker than another. That split-second window, that's your chance to buy low and sell high, literally simultaneously. And you know what's really fascinating about this? These hyper-fast profit-seeking trades actually act as the market's built-in autocorrect. By constantly hunting down these little discrepancies, arbitrageurs force currency prices to align globally. They're essentially keeping the entire market balanced and efficient for the rest of us. Moving right along, Section 2, Executing an Arbitrage Trade. To actually pull this off, you have to move through a completely mechanical, blazing fast 5-step process. You identify the opportunity, select your currency pair, calculate the exact profit, execute that order with ruthless speed, and then immediately monitor and close. I mean, if you hesitate for even a single second, the window just vanishes. And to maximize those chances, you really need to hunt where the heavy action is. We're talking major, highly traded pairs like Euro USD, USD JPY, or GBP USD. The massive global volume on these pairs is exactly what churns up those frequent, momentary pricing gaps. But hey, you've got to watch out for the hidden trap here: transaction fees and tight spreads. Think about it. If you're only capturing a tiny fraction of a penny on the arbitrage, a bulky broker fee is going to instantly turn your winning trade into a loss. Your math absolutely has to be flawless before you click buy. So, Section 3, who are the arbitrageurs? Well, you certainly aren't trading in a vacuum out there. The battlefield is packed from everyone from massive institutional banks moving millions of dollars right down to specialized professional forex traders and even individual retail traders. But honestly, your absolute biggest competition? Automated trading systems. These aren't just simple scripts. They are highly aggressive bots, scanning dozens of exchanges to execute trades in mere milliseconds. They literally spot and steal an opportunity before a human brain can even process the chart. Okay, Section 4, the role of liquidity. Now, to have any hope of outpacing those bots, you need deep market liquidity. If a market isn't liquid, meaning, there just aren't enough active buyers and sellers, your own large order will actually shift the price against you before the trade even completes. And poof, there goes your margin. So making this work requires a massive, perfectly balanced ecosystem. Central banks influence the overall liquidity via monetary policy. Major banks pump in that heavy interbank volume. Electronic platforms offer the instant access, and forex brokers act as your bridge. It all ensures the market stays fluid enough for you to jump in and out instantly. Let's bring this all down to earth. Section 5, Top Brokers in 2026. Let's look at a quick head-to-head. You've got 8cap offering a minimum spread of 0.06 and 1 to 200 leverage. But then look at AvaTrade. They're offering an incredibly tight minimum spread of 0.0001, 1 to 400 leverage, plus a 40% bonus. When your entire strategy relies on grabbing microscopic fractions of a cent, getting a tighter spread is hands down your biggest competitive edge. And you know what the surprisingly good news is for retail traders? Both of these highly regulated platforms require a minimum deposit of just $100. Yep, $100. You really don't need a massive Wall Street budget to step into this high-speed arena anymore. If we expand out to the broader top tier, IC Markets is leading the pack right now with ultra-low raw spreads starting from absolute 0 pips.
For professional scalpers, zero pip spreads literally mean instant profitability the very second the market ticks in your direction. FX Pro and AvaTrade follow really closely behind, offering that tight spread along with the strong regulatory oversight you definitely need. But here's the kicker. A great broker is completely useless without the right technology. Institutional-grade platforms like MetaTrader 4, MetaTrader 5, and CTrader, they're mandatory. You simply cannot execute an arbitrage trade on some clunky web interface. You need advanced, robust software wired directly into those deep liquidity pools. So to wrap this up, forex arbitrage is this incredible high-wire act that physically balances the entire global economy. But it demands a perfect storm of deep liquidity, advanced tech, and split-second timing. The global market is absolutely full of these fleeting opportunities. So the ultimate question is, are your tools and reflexes fast enough to catch them?